These talks are brought to you by Claritax Books and are proudly sponsored by 6 Forward Capital Allowances.
Welcome back to our series of talks on capital allowances. Our recent videos have examined the legislation and practice that together determine how capital allowances can be claimed for fixtures in property. Today we'll be looking at a number of examples to see how it all works out in practice for sales and purchases of property. In our first example, we'll assume that Anna had a new care home built in 2007. Move on 8 years and she's now selling it to Beth in 2015. Anna has been well advised and has claimed the maximum possible capital allowances for fixtures in the property. As such, the pooling requirement has been met as far as is possible, and a Section 198 election is needed to fix the transfer value of the fixtures on which a claim has been made. The parties must agree the figure to go into the election to cover those fixtures. As the property was built for Anna before April 2008, however, she couldn't claim for those integral features that did not qualify for allowances at that time. As such, these are of no interest to Anna, but Beth will want to capture the value for tax purposes. This will involve a valuation and the application of the apportionment formula we looked at last week. For our second example, we'll assume instead that Anna has only made a partial claim since the property was built back in 2007. For simplicity, let's say that a claim was made for all qualifying items except the central heating system. Now, nobody can force Anna to claim for the heating system, but if she does not do so, Beth will be denied tax relief accordingly. Normally, therefore, Anna will agree to make a claim now to meet the pooling requirement. Assuming that she does so, the fixtures election can then include the heating system as well as the other fixtures for which she has claimed. An apportionment will still be needed, as before, for the integral features. In each of these first two examples, the current vendor was the original owner of the property. In practice, of course, it's often the case that there have been previous owners, and this does complicate the capital allowances position, but not usually fatally. Assume for our last example today that Venus is selling a hotel to Pluto in 2015. Venus bought the property from Mars back in 2004 and confirms that no fixtures election was signed at that time. The legal paperwork from the purchase in 2004 was in fact silent about capital allowances. Now, it's established that Mars was the only previous owner, but no details are available about any claims made by Mars, who can no longer be contacted. In relation to any given fixture, there are only two options. Mars did claim allowances, or it did not. If Mars did not claim, Venus is free to do so, and indeed must make the maximum possible claim to preserve the value for Pluto. That will involve making an apportionment based on the purchase cost back in 2004. If Mars did claim, it was required to bring a disposal value into account. As we know that no fixtures election was signed, it follows that an apportionment is still the only correct way to compute that disposal value for Mars and the acquisition price for Venus. Whether or not Mars in fact brought a disposal value into account is not relevant. So, it actually makes no difference in this scenario whether Mars made a claim or not. Either way, Venus can and should make a claim based on an apportioned value of the purchase price in 2004. Next week, we'll look at one last example on this theme, illustrating the more complex issues that arise where there have been several previous owners. Thank you for watching. I'm Ray Chidell, author of Capital Allowances and of the A to Z of Plant and Machinery from Claritax Books. This talk was sponsored by 6 Forward, an independent property tax consultancy working with accountants to enhance capital allowances for their clients.